Hi, I'm Sarah Bunwell, the editor of insuranceinvestor.com and fundoperator.com. I'm here with Kay Hope, head of ESG research for Global Fixed Income, Bank of America.
Hi, thanks so much for having me.
So my first question to you is, a lot of people have said that ESG didn't predict the current events in Russia/Ukraine. Does that mean that ESG is all wrong or that it's not fit for purpose?
Investors use ESG to mitigate future risks, predict or look for opportunities, and focus on longer-term strategic goals. But I've never heard of it as a predictor of war. And I would say ESG is not all wrong. The conflict has certainly put energy issues front and center. What we're seeing today is absolutely going to hasten the move away from fossil fuels. And ultimately, that's positive from an E perspective and an S perspective, environmental and social. I think beyond energy issues, we expect organizations to be good corporate and national citizens. And ESG brings that into greater focus. ESG has investors requiring more data and looking at more items that are non-financial metrics. It's driving this move toward environmental and social targets and a broader move toward transition, which I think overall is definitely a positive thing and much more of what ESG was created to do.
Great, thank you. So what can we learn from the Russia-Ukraine situation in terms of what it does tell us about how to build scalable and workable ESG strategies?
At the end of the day, most people view the current conflict as a deeply unfortunate and deeply unexpected event. ESG is a process. It's not an answer all by itself. The current conflict should be reminding us to evaluate and reevaluate as more information becomes available. Transition-related issues don't go away. As we just talked about, they're now at the forefront. We need to transition away from fossil fuels. We know that. We still need to tackle environmental and social issues. Countries need to be setting targets, and so do companies. And they need to be thinking about how they're going to meet them. And all this remains in focus. I think the other important thing is that investors still have a lot of interest in ESG. Our own work shows that ESG strategies are continuing to see inflows. So January was a pretty dire month for global bonds. And yet all regions showed inflows into ESG strategies versus non-ESG strategies when we look at global bond funds. Europe now holds just over half of global assets under management that are ESG linked, even though it only has 12.5% of global bond assets under management. The US is just starting from a much lower base, but it is growing very, very fast. And we do expect that to continue. And we all know that there's been enormous growth in ESG on the equity side.
That's really interesting. And you mentioned earlier that, Russia-Ukraine is going to hasten this kind of these outflows from fossil fuels. Do you think investors are right to exclude sectors like fossil fuels and others like that as part of an ESG approach to investing?
That's a really good question. And it's something that we hear a lot. And I do speak with investors who specifically exclude certain sectors, including oil and gas. On the one hand, I would say investors do tell us that oil and gas is probably one of the biggest sectors where they see themselves reducing exposure in the next 3 years. We see this in European credit surveys that we run on a regular basis, but we also see it in surveys of emerging market investors that we run, which is particularly interesting because oil and gas is the largest single sector for emerging markets. The question is whether all of those investors choose to completely exclude fossil fuels or whether they choose more of a best-in-class approach. And the reason I think that's important is sort of the other side of this, and that's that the ESG approach we're seeing in Europe is moving away from complete exclusions and moving toward greater engagement of issuers. So European credit surveys that we've run already have shown us that 90% of European investors either use ESG to some extent in their decision-making or already adhere to strong ESG standards. Our 2022 European credit survey also showed a big move toward engagement over exclusions. And this was something really interesting to us. For instance, in 2022, 11% of high-grade investors told us that they exclude by sector, compared to 43% just a year ago. At the same time in 2022, 44% of high-grade investors told us they prefer using engagement, and a year ago, that figure was 10%. So these things are changing.
It's really interesting. Okay, last one from me. What do you think are some of the key trends shaping the world that institutional investors should keep in mind when developing and updating their ESG strategies for the future?
I think there are two key things that I would want to highlight. And in a sense, they're kind of related. The first is interest in diversity, equity, and inclusion. And this is something that has been a factor for a long time, but continues to maintain momentum. Bank of America just wrote its annual piece on diversity recently. And this year we focused not on whether or not diversity and inclusion are important, but on actually what it costs you if you lag. And in fact, there is a quantifiable way of looking at these figures. If your company is not inclusive, you tend to be a company that has to replace people more often. You tend to have more people of the same background, which means a narrow range of ideas. It means less innovation, lower revenues, and you lose out on cash flows as well. And we looked at that across diversity metrics, whether it was disability, LGBTQ, racial disparities, as well as gender. And then I think the other issue that people should be thinking about isn't just transition, but a just transition. And what we mean by that is including social issues when you think about environmental issues. It's sort of where the two meet. And the reason we need a just transition is net zero and just transition cannot only be for rich countries. Poor countries need to be brought along as well. There are 600 million people in Africa who do not have regular access to electricity. These countries need to be brought up the development curve. They can't be left behind. Without that, you have massive inequality. You have differences in digitalization. You have inability to grow. How can you run a factory if you don't know when your electricity will work? And I think more and more, we're talking not just about environmental issues, not just about social issues, but where those issues actually overlap and how we can bring everyone along on the ESG journey.